All right, welcome everyone. Thanks for tuning in to this episode of the Why Retirement Show. Today's episode, we're talking about the taxation of collectibles. We'll talk about what the IRS considers a collectible, how collectibles are taxed. We'll look at specifically wine as a collectible. We'll talk about the differences between a hobbyist versus an investor versus a business and why that matters. We'll mention consignment sales, we'll walk through an example, and lastly, we'll talk about some key takeaways and planning considerations. All right, so let's jump in. What is considered a collectible? Okay, so under the IRS, a collectible includes works of art, rugs and antiques, metals and gems, coins with limited exceptions, stamps, alcoholic beverages, including wine, any other tangible personal property specified by regulation. Okay, if it's tangible and people buy it hoping it goes up in value, the IRS is probably paying attention. All right, let's talk now about how collectibles are taxed. Okay, and using the same capital gains, the standard capital gains framework here, we got short-term and long-term. Okay, and short-term collectibles are taxed exactly like short-term capital gains in that if the item is held for less than 1 year, it's going to be taxed at your ordinary income tax rate, right? Your marginal rate, wherever you fall. Okay, if it's long-term, right? We know long-term capital gains, for regular, the sale of a stock or the sale of an, investment property is going to be taxed at either that 0%, 15%, or 20% rate, right? One of those brackets. It all depends on how your ordinary income and then the capital gains is stacked on top of that to determine which bracket you fall in. And that's the percentage you're going to pay for regular capital gains. Now, for collectibles, it's a little bit different. I should say it's a lot different. The most you'll have to pay is 28%. Okay, that's the maximum. And how you determine what you're going to pay, it all depends on your regular ordinary income rates, right? What tax bracket do you fall in? And what I mean by that is, let's say you're in the 24% tax bracket, right? That's where you're kind of capped off here. That's your marginal rate. And you have the sale of a collectible, okay? You're not going to pay the 28% because, again, that's the maximum. That's the cap. You're going to pay capital gains tax at that 24% rate on the sale of that collectible. Now, let's do another example of where you're in a higher tax bracket, right? You're in the 32% tax bracket. And you have a sale of a collectible, you're going to be capped at 28%, right? That's the maximum federal rate for the taxation of collectibles. You're capped at 28%. You don't have to pay the 32%, right? If it was short term, like I said before, then it's taxed at ordinary income, and if you're in the 32% tax bracket, you're going to pay 32% on that the sale of that collectible asset. Okay, one point that's worth mentioning when it comes to how collectibles are taxed is I recently did an episode on net investment income tax, okay? And that applies, it's an additional tax that can apply to passive income. I'm not going to hash through all of NIT right now, but just understand that could factor in, right? And if you have to pay that extra 3.8% on top of the 28% cap for collectibles, then you could be looking at 31.8% combined, for federal tax on the sale of a collectible. Okay, so I want to talk a little bit about wine. Now, when we're talking about the taxation of collectibles, I mean, this applies to whiskey, wine, art, antiques, right? Any of that stuff. But I just want to focus on wine because I recently had a conversation with somebody around the selling of wine and the taxation of wine. And so I wanted to focus a little bit in on wine, right? So wine is definitely treated as a collectible if it's purchased for an investment, right? Not consumption. It's professionally stored. It's sold through an auction broker or private sale. And the expectation is it's going to appreciate, right? And I think it's important to understand that if you're just buying it to consume it, right, there's no sale. There's no sale at the end, right? If you're buying it with the intent of this collectible, or what we're talking about now is wine, this bottle of wine, to increase in value and then sell, the intent is that it's a collectible and it's going to be taxed as such, right? It's a capital asset. The IRS really looks at, like I said, intent, the frequency, the storage, the records to figure out whether or not it's going to be a collectible. But the only way it's taxed is going to be if you sell it, right? If you're not selling it, if you just buy, an antique or a bottle of wine and you're holding on to it, or some trading cards, it's not taxed, right? It's only taxed if you sell it for a gain. Now, we will talk about losses here in a minute, and when or when not you can claim a loss, right? And that brings us to the difference between an investor, a hobbyist, and a business. And again, the IRS is focusing on your behavior, your intent, not labels, right? You can't just label yourself. You're acting like a business and you say, well, I just do this as a hobby. But if it looks like a business, smells like a business, acts like a business, the IRS is going to say, no, you can't just say it's a hobby, it's a business, right? Or vice versa. You could say, well, this is a business. I have this fishing business where I take friends out fishing, and so I write off everything for my boat. If the IRS looks into it, they could say, yeah, you're saying this is a business, but it's obviously a hobby where you and your friends just fill the cooler with beer and go fishing every few months, right? So you can't just label it, this is what it is, that's what it is, right? You have to look at intent, right? Okay, and what we're looking at is the difference between a hobbyist and, again, an investor, and when it becomes a business. Okay, so a hobbyist, you just got to think it's personal enjoyment, right? An investor, you're actually looking for appreciation and resale, right? You're no longer just doing this for, the love of what you're doing. The intent now is, I buy trading cards and I sell trading cards. I'm looking for appreciation, right? Then you're classified as an investor. And the distinction between a hobbyist and an investor is important, is when it comes to losses on collectibles, right? The gains, it doesn't change the taxation of collectibles with the gains, right? What I just went over with the 28% cap, it's going to be taxed the same regardless of whether you're a hobbyist or an investor. But it's the losses, right? Investment collectibles, if you're an investor, capital losses are allowed. Now, these are passive losses, capital losses, and they're subject to limits. You got to look beyond it. You can't just deduct a gigantic amount of losses. There's rules around that. I'm not going to dig into that right now. But when you're a hobbyist and it's personal use, you can't deduct the losses, right? You can't deduct personal losses, right? So like if you have a car, right, and it you're going to sell it at a loss, you can't deduct that loss as a passive loss, a capital loss, because it's a personal use asset, right? So same thing's true for collectibles. If it's personal use, there's no deduction of losses. Okay, and if you are a hobbyist and you want to say, well, I want to maximize these losses, just know that because of the limitations on capital losses, it's not like you're missing out on some giant amount of tax savings. I mean, it's significant, and every amount matters, and it adds up over time. But it's not the end of the world. Again, I don't want to get too bogged down on capital loss carryovers and the rules around passive losses here, but just want to point that out. Okay, so again, we just talked about hobbyists, it's personal use, right? An investor, like I said, you kind of expect the appreciation in the resale, right? So maybe you're buying graded trading cards, right? Or investment wine, like maybe you're buying, a unique, rare bottle of wine and you're professionally storing it. That's IRS would look at that and say, well, you're kind of acting as an investor here, right? It's important that you keep good records if you are an investor. And the reason for that, again, is that if you're an investor, then some of those losses are going to be deductible, right? The taxes aren't, but the losses will be. It's also important to remember the how expenses are factored into this, right? So the storage, the grading, right? You can add these things to the basis of that collectible, that bottle of wine, that trading cards, or that antique, right? So if I paid whatever it is to have this item graded, right? I paid $100 to have this item graded, and I bought the wine for or the trading cards for $1,000. I can add that $100 to the basis, and so now my basis would be $1,100. So when I go to sell it, that basis, added basis, will lower the amount of capital gains on the sale of that asset, right? And with expenses, you want to do a good job of keeping records, right? In case it is ever scrutinized, especially when you get higher and higher in the amount of money you're talking about, the more likely it probably is that it may be scrutinized, right? Now, you don't want to be thinking you can deduct operating expenses, right? Because operating expenses and regular expenses, you can't be writing off all these things as operating expenses because you're an investor or a hobbyist, right? Only a business can deduct operating expenses. What we're talking about is not deducting expenses for, the operating as an investor or a hobbyist. We're talking about adding basis to the asset itself, which in turn could potentially lower the amount of capital gains from the sale of the asset, right? Okay, so we covered kind of investor versus hobbyist. Let's talk about a business, right? And again, we'll use wine as the example. When wine becomes a business, okay, and this means it's no longer a capital asset, meaning we're no longer talking about the taxation of collectibles the way I did before with short-term and long-term. Now we're talking about business income, ordinary operating income, right? Ordinary income for the business. You're no longer working in this capital asset space, right? Because inventory isn't going to be subject to this capital asset collectible taxation. It's just income for the business, right? And I think the IRS would look at things like, okay, what are the operations going on here to determine if it's a business, right? Are you doing lots of sales? Is there inventory? Are you marketing? Is this a restaurant seller? Is this a distributor? Is there, any sort of dealer operations? Then, you're looking past the capital asset part and the capital taxation, and you're just looking at income, right? Ordinary income for your business at that point. Now, the business is going to pay ordinary income, and then you have all the other business taxes, right? Self-employment tax and whatever else you have associated with your business. So, recap, if you're a hobbyist, you get the capital gains if you sell it for a gain, and you don't get any loss deduction. Okay, you can't deduct any losses. If you're an investor, you pay the capital gains, the same as a hobbyist, but you can deduct the losses because now you're in the business of, not as a business, but you are an investor and you're, frequently buying and selling and whatever collectible it is in hopes of capital appreciation, right? And if you're a dealer or a business, this is what you do for a business. You're no longer an investor. This is, you're marketing, you're distributing, you're customer facing. Then you're a dealer or business, and you're talking ordinary income, right? It is important to note, again, like I said, the IRS isn't looking at labels, and a hobbyist or an investor can become a business without realizing it, right? You can't continue to say, well, I'm an investor. I'm not. This isn't what I do as a business. So I'm going to be taxed at these capital gains rates instead of ordinary income. Again, if you're doing a lot of sales and it looks like a business, smells like a business, acts like a business, they're probably going to consider you a sole proprietorship, and you'll be paying taxes at ordinary income rates as a business. Okay, one last point, consignment sale, right? Or you go to like an auction house or consignment, right? You just have somebody else sell the collectible for you. It doesn't really change anything as far as the taxation, whether, if you're a hobbyist or an investor and you go through a consignment sale, it doesn't change the taxation, right? The taxability of it. But it's important to track, commissions or fees to include in the basis, right? Because you can include that in the basis of the asset. Okay, let's do an example of a bottle of wine sold on consignment, okay? And this person is an hobbyist or an investor, it doesn't matter, right? Because they're selling for a gain, it's going to be the same thing. And so they purchased a bottle of wine for $2,000. they paid some money to have it, I don't know, graded or stored. And so, that cost $500. So now their total basis in this bottle of wine is $2,500. Okay. They sold it 10 years later, right? Now we're talking long term, right? 10 years, longer than a year later for $10,000. Okay. And the fees to sell it were $1,500. Okay. So we had $7,500 of gain, and then you can add the fees to the basis, right? So it actually increases your basis from $2,500 up to $4,000. And so your net proceeds are $6,000 from the sale of this wine. Okay. And because it's long term, we're looking at a cap of 28%, but then it's going to be up to 28% unless you're in a lower tax bracket. Let's say you're in a 32% tax bracket. So you're capped at that 28%. 28% of $6,000, which is the gain, the net proceeds from the sale, and you're going to pay $1,680 in taxes on the collectible. I know it's hard through the audio format, but I just want to run through one quick example there. All right, so let's wrap up here with some key takeaways and planning considerations here. Again, hammering this point home, the IRS is going to focus on intent, frequency, and behavior, right? So it's important to keep that in mind. Documentation, it affects the basis of a capital asset, right? Or a collectible. If you're a hobbyist or investor, right, you want to keep good documentation when you bought something, how much, so you can determine the holding period and any other costs like grading or whatever that went into that particular collectible, because that gets added to the basis and in turn could lower the capital gains you pay on it. The losses, again, only for the investor when it comes to capital losses, right? The hobbyist can't deduct the losses. And one thing I didn't touch on was the timing, right? So the timing impacts a lot of other things, especially when you're looking at the big picture in retirement planning or financial planning or tax planning in general, right? The timing is going to affect, NIT, like I talked about, IRMA, Roth conversions, RMDs, all these things play in to the tax planning, right? So, there's some planning considerations on if you are going to sell a collectible. Maybe there's an opportune time when you look big picture of what year and when you're going to sell it, right? It's just important to keep that all in context when you zoom out. Okay, so that wraps it up. The taxation of collectibles. Try to get some guests on here coming down the pipeline here. I'm not sure what that exactly looks like right now. But as always, if there's anything in particular you'd like me to talk about on the show, if there's a specific question or something you've come across in the news or heard about, feel free to email it over to aloha@hawaiiretirementshow.com, and I'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Katita, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.